Kristine, it's a real pleasure to be here today. And Scott, a very warm welcome from me as well. As we'd heard from Stidart, you have many and very impressive achievements. So we are super excited to hear from you today. Tell us about Generate and tell us where the company is at today.
Thanks so much. It's wonderful to be here and an honor to be among the group of folks that are talking about such important issues today. Generate is an investment and operating platform. Those are very specific words we've used to describe a very different model of investing and operating in sustainable infrastructure. We've been around since 2014, and we really started the business with the understanding that the capital markets were broken with respect to funding the infrastructure that we need to solve some of the world's most important problems, including climate change, energy poverty, water scarcity, and food insecurity. We recognized there were a lot of solutions out there that actually work for customers and communities, but the capital markets weren't coming to fund those solutions or the scale up of those solutions across the world. And because it's an infrastructure problem, you need third-party capital and you need operational capabilities in order to build infrastructure projects that serve these communities and customers for generations. Not just building today and walking away, but actually making sure that these projects operate successfully for the customers and communities they're designed to serve. So we've now built over 2,000 projects across North America, across the power, transportation, and water and waste sectors, all sustainable infrastructure projects, from microgrids and community solar farms and energy efficiency retrofits in the power space, to things like electric buses, as we were just listening about on the prior panel. We brought the world's first electric bus leasing program forward with one of the largest electric vehicle companies in the world. We've been implementing hydrogen fuel cell infrastructure for other transportation applications, and we're one of the largest operators of anaerobic digesters, which take food waste and animal waste and turn it into clean power or clean gas, fertilizer, and clean water. So that's sort of the range of types of things that we do. And as I mentioned, we took very deliberate words in describing who we are and what we are. On the one hand, we're an investment firm where we have every financial services tool in our toolkit, from corporate equity to project equity, corporate debt to project debt, and everything in between. Anything that the project developers and technology companies who are pioneers of what we call this infrastructure revolution need in order to get projects built. And then on the other hand, we also operate these projects for their lifetimes. And so we have quite a bit of our team focused on just the actual physical operations of these assets to ensure that everybody benefits as expected from the outset. So it's a very different model. We are a business, we're not a fund manager. And we put these projects in place in partnership with project developers and technology companies, and then we serve the customers and the communities for the entire life of the asset.
And tell us a little bit more about that, because you do have a relatively unusual investment vehicle, having set yourself up as an operating company. Why did you do that? You dived in on it a little bit already, but tell us more about it. And how has the structure worked? What has worked well and what has worked less well for you?
Well, the reason we're here today is convention has failed us. Quite simply, the problems that we're talking about, whether it's climate change or some of these other issues, convention created. So we didn't want to use convention to solve the problem. We said, from a clean sheet of paper, what's the right way to do this? And from a clean sheet of paper, you know that you need to be flexible in the types of capital that you provide, not single mandate, single toolkit, the way that a fund typically is. Single tool, sorry. You have to be long-term to match the life of the assets and the responsibilities that you should be taking on when you build an infrastructure asset. And so you have to have a really different time horizon than the typical 10-year self-liquidating closed-end fund. And furthermore, you have to have that operating capability to make sure that the projects actually work and that they work through time and they work through changes in the external environment. And you need the expertise and the people power and the technology to be able to do that piece. None of that really is what you would describe as a typical private equity fund's activity or mandate or structure. And so we really thought hard about this and came up with a pretty easy, straightforward answer, which is let's be a company. A company is a going concern. It is permanently capitalized and it is used to serving customers. That is what it's meant to do. So as I always say, a company is just a group of people, and whether you're organized as a fund or whether you're organized as a company, it's still going to come down to the group of people that you have. But we've designed it in a way that aligns all of our incentives as the people inside the business with the people that we're serving, the stakeholders in these communities, the stakeholders amongst our investors, the stakeholders that are our customers, our supply chain. You have to really think hard about how to align all of those stakeholders in order to have a license to operate in the infrastructure space.
Wonderful, thank you. Another new avenue that you're pursuing, I know you are looking towards Europe, and I'm based in Europe here today. I'm actually calling in from Denmark, so I'm very excited to hear. Tell us a little bit about what dynamics you see in the European markets. What is it that makes it attractive for you, appealing to go into the European market, and perhaps also for our US audience, what is it that makes the European market different from the US market, and how do you perhaps have to modify your strategy or your investment approach to go into the European market?
Good question. So we decided to move into Europe to expand from North America because there is a tremendous amount of opportunity there for economically compelling financial returns and huge impact on the sustainability arena where we've been so active in North America. Distributed infrastructure in particular, we talk about the 4 Ds of infrastructure: distributed, decarbonized, digitized, and democratized. Distributed, democratized, decarbonized, and digitized infrastructure is happening everywhere because it is better economic value for the customers, for the users. And as a result, it's better economic value for investors and owners and operators like us. So we looked at Europe and saw tremendous momentum from the policy environment to be supportive of the shift to the 4 Ds or a more sustainable infrastructure. We also, most importantly, saw the demand from customers just continuing to surge, whether you're in Europe or in North America, which again is driving the demand for these sustainability solutions. It's not policy, it's not investors, it's customers who want to benefit from sustainable infrastructure like resilient solar and storage microgrids, like hydrogen-fueled transportation, like electric vehicles, like waste-to-value projects that many will call the circular economy, right? These are all areas of infrastructure that are generating tremendous customer demand because the customer value proposition is compelling. And that's true in Europe as well as in North America.
So you don't think going into the European market is going to change your investment approach or your strategy? You'll basically be pursuing what already makes your strong DNA today?
Yeah, it's been a highly differentiated strategy in the US. There aren't a lot of people who have figured out how to build, own, operate, and finance the distributed infrastructure solutions that these customers want. And so we knew we've figured out a model here in North America, and we were pleased to see that it applies to other geographies like Europe. And exactly right, we're not planning on changing the approach. We're just hoping to expand.
Very good. Another question. You are a super creative company and done so well going into new avenues. Tell us a little bit about what new initiatives, what are the new technologies that you're looking at today to perhaps support and scale up and to take onto your portfolio going forward?
So we've been active across the circular economy for some time, in particular with food waste processing and animal waste processing. And as you might guess, animal waste comes from farming operations. So there's a real overlap between water and waste management, like we've been doing, and the agriculture market or agriculture sector. We're very eager to see where else this approach that we've employed can be applicable in the agriculture space. So you'll see more from us in that arena over the coming years. We're also very eager to expand more deeply within the sectors we've already been active. So in power and transport and water and waste, you'll see a lot more solutions come to the market. We have about 40 project developers and technology companies we work with across those three sectors. They themselves are expanding the services they offer and the types of projects they develop. And as a result, that gives us an opportunity to work with them to go from, for example, a community solar project development operation to solar plus storage microgrids, a very natural adjacency for those partners where we've already been active and we have expertise. We're going to see a lot, I think, of attention applied to the water arena over the coming years. We still struggle with the price signal or lack thereof in most markets for water, but there will be, in particular around the waste management of water, there will be price signals and important innovations that need to be built into infrastructure. So we're eager to see what we can do to be helpful in that market. And then finally, I'll just say we're spending a fair bit of time thinking about how we can work with cities to make them smart from an infrastructure standpoint and sustainable from an infrastructure standpoint. That spans a whole range of solutions from straightforward energy efficient street lighting to things that are a lot more complicated, like combined heat and power, or even how do you think about the digitization of the community and making sure that that has a sustainable energy footprint, for example.
Very, very exciting. Going back to your first point, a little bit about the energy sector and storage. You talk about storage and batteries, and storage is on everybody's mind because that will be potentially disruptive depending on when it becomes more commercial. Tell us a little bit more about how you see that market and what you see the time frame and how's that impacting your investment going forward.
Battery storage is so last year. No, in all seriousness, we started with battery storage back in 2014. We were the first institutional investor funding battery storage infrastructure projects all the way back then. And while there are a lot of potential applications for batteries on the grid, in fact, I think the McKinsey report that I remember reading had 18 different ones. We've been focused on one particular application because it is in the money today. It is an economically interesting proposition for customers and thus for us. We have done about $200 million worth of battery implementations in that one application of behind the meter battery storage over the last several years. And it is funny still to hear that people think it's a technologically risky proposition. I remind people that you've had lithium-ion batteries next to your brain and right on top of your laps, next to some other parts of your body that you hold dear for many, many years. And we're talking about batteries that are sitting in basements or in very protected environments that are made very safe as a result of the infrastructure that's put around them. So it's not a technologically risky proposition to do batteries in the same way that solar wasn't technologically risky in 2005. It was 50-year-old technology then, and yet it wasn't considered mainstream. It was considered risky by the capital markets. The thing that Generate has done very well is it has not listened to the mainstream, and it has said, we can figure out how to make this seemingly risky technology a very safe infrastructure project. And that's what we've been doing since 2014. And if we can keep doing that, we can bring a lot of these solutions that are actually bankable into the realm of bankability and thus into the realm of scalability and actually meet the problem of climate change at the scale it presents us, trillions and trillions of dollars.
Wonderful. Thank you. Last question. I think we just have time for one last question. And I think it's on many's mind that the whole renewable energy transition investment space is very crowded today. And so the natural question for you and a company like yourself is, how do you still find attractive returns? And you come and discussed a little bit how you were pursuing the path that's less used by others. But tell us a little bit more about how do you actually see that environment going forward? And do you feel that returns are going to be compressed going forward?
Well, I think what we've seen in areas like utility scale wind and solar, or as the market has gotten comfortable with the risk profile of those assets, a lot more funding came into them, and certainly the returns compressed for those participating in those markets. We don't tend to participate in markets that are highly trafficked until after we have shown people that it makes sense and makes money. And so we still tend to be in an area where mainstream investors aren't. It is great to see the enthusiasm for ESG broadly and the capital flows coming into sustainable infrastructure and renewable energy. We need 1,000 generates to address the problem at the scale at which it presents itself, as I was mentioning, trillions and trillions of dollars. We aren't going to do it all ourselves here at Generate. We're obviously hoping to be the tip of the spear, showing people how to make money in sustainability. We've been trying to do that for 7 years. I think we've done that. And we're really excited to see a lot of new fellow travelers trying to solve some of these really important problems. If it means that there's a slight degradation in returns for the overall market, I think we can all tolerate that. The risk profile of these assets is very safe. And as a result, the risk-adjusted returns are incredibly attractive today. They have been for 7 years, and I don't see that changing for quite some time.
And speaking a little bit more about that, tell us a little bit more about your operating model, because I know you have you have a strong network of development partners and operating partners that you work with. So tell us a little bit more about the operating model and how you actually can generate those returns while at the same time being so climate friendly and so attractive from that perspective.
Well, most of our team at this point is dedicated to operating assets successfully for our stakeholders. And in order to do that, we really do need to have the technical expertise in-house. We need to have folks who turn wrenches, clean pipes, wash panels. When we find partners who can do that with us at the same level of quality and with the same time horizon, and importantly, with the same stakeholder assessment and stakeholder alignment model that we have, then we can work with partners on that. But what we found is, in general, there aren't a lot of companies with whom we can work to actually operate projects successfully for 20, 30 years. The only organizations really out there designed to do that are the utilities. They do a great job of it most of the time with central station, monolithic, large-scale infrastructure like we've had for the last 100 years. But not very many of them have figured out how to do it on a distributed basis, the way that we have been focused. And as a result, we've had to build a lot of that capability ourselves. There's quite a bit of technology involved in managing these assets, monitoring these assets, ensuring customers are getting what they want. And then there's just people who need to be in these communities and talking to these customers and making sure that at these assets, everything is going as planned. So it's really like an independent power producer or utility on the operating side, and coupled with the financial services that we offer on the financing side, it's a really nice cross-fertilization of knowledge that we're able to understand risks a lot better when we think about an investment, and we're able to understand customers' needs a lot better because we talk to our customers. We have over 2,000 customers that are telling us what sustainability solutions they want. And as a result, we can offer that access to those customers to the project developers and technology companies with whom we partner. So it's a really nice virtuous circle. The more solutions we have from the technology side, the more customers we can solve problems for. And the more customers we talk to, the easier it is for us to pull through those solutions to those customers and solve their problems. Wonderful.
Good for the investor returns and good for the climate as well. Tell us a little bit about, and I'm hoping we still have, I think this is going to be your last question. Scott, thank you. Tell us a little bit about the climate impact. I know you've been publishing numbers and they're quite impressive. Just tell us here as the last question, a little bit about the results you've been able to achieve for your investors and for your company.
So in the waste space, the circular economy that I mentioned, where we've been diverting waste from landfills, we've found that our asset base is taking waste away from these landfills to the tune of 11 Golden Gate bridges worth of mass, which is pretty significant, obviously. And if you look at the carbon dioxide emissions that we've averted with the assets that we've built from a climate standpoint, 43 million megatons of CO2 are reduced as a result of these assets, which is the equivalent of reforesting half of California. So clearly the impact is there on the environmental side with the announcement we made this week of raising $2 billion from institutional investors all around the world. Clearly the financial impact is there and the rewards are there. It really is a wonderful story that we all need to hear more of, which is that you do not actually have to sacrifice your goals for financial rewards in order to achieve the environmental and social impacts that we've been focused on here.
Wonderful. I don't think we can finish on a better note with that kind of statement. I wish you really continued luck and look forward to continuing to follow Generate. And I think with that, Scott, I want to say thank you for informing us and all the audience about Generate and best of luck.
Thank you all very much.
Thank you.